Good morning, everyone. This is Marshall Giller bringing you the morning comment for June 11th. Well, the currency wars are back. The Reserve Bank of New Zealand not only cut rates by 25 basis points, as the market largely expected, but also announced an easing bias. New Zealand remains one of the few G10 countries that can still lower interest rates. At 3.25%, the cash rate is still over 1 percentage point above the next highest country, Australia. So there's plenty of room for the market to revise down its estimates for New Zealand interest rates. It's no surprise then that New Zealand dollar was the worst performing G10 currency overnight. I'd expect it to remain weak for some time until the market has fully digested the likelihood of further easing in New Zealand. Now, South Korea also cut its key rate today, in this case to a record low, as overseas demand weakens and Middle East respiratory syndrome threatens to derail domestic demand too. So one reason for the weak export performance of Korea is the won's strength against both the yen and the euro. Considering today's moves by both New Zealand and South Korea, it looks to me like we're back in the currency wars. That's another reason why I expect the yen to weaken further, despite what Governor Kuroda said yesterday. The Australian dollar, on the other hand, was the best performing G10 currency overnight as the unemployment rate unexpectedly declined and the number of people in work rose sharply. The figure came as a big surprise as other indicators of Australia's economy aren't particularly strong. The market isn't expecting any more interest rate cuts this year, despite what Governor Stevens says. That's likely to support the Australian dollar going forward, at least until some new statistics come out to change people's views. Oil continued its rally after the U.S. Energy Information Agency data showed a much bigger than expected decline in U.S. inventories. However, the data also showed that U.S. oil output hit what looks to me like a record high. I think the market is focusing too much on the inventory situation and not enough on the production. I still believe that oil prices are likely to fall and that the Canadian dollar and Norwegian krone remain vulnerable to such a change. As they say in the oil business, high prices cure high prices. Chinese data showed the economy there stabilizing. The country released its retail sales, industrial production, and fixed asset investment for May. The data presented a better picture of the economy than recent inflation and trade numbers, which had suggested stagnation. Nonetheless, they had no impact on the Australian dollar or New Zealand dollar. As for today's highlights, Sweden's CPI and CPIF for May are due to be released. More signs of weakness in prices could prompt the Riksbank to ease monetary policy further. This is likely to keep the Swedish krona under pressure. In the U.S., retail sales from May are expected to accelerate. April's retail sales figure was disappointing and consumer confidence declined. A positive surprise today could ease market concerns and strengthen the dollar. Initial jobless claims for the week ending June 6th are also coming out. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Giller, head of Global FX Strategy at IronFX Global, wishing you solid trading.